Hello, I'm Troy Harmon, Chief Investment Officer at Henssler Financial. I'm joined by Nick Antonucci and Jacob Keene, and this is your market update for November 2018 from Henssler Financial. So guys, October was a wild ride. We lost a significant amount of value in the market, but we never really got the official correction, which would have been 10%.
9.88% is as close as we came. Pretty darn close, but didn't quite make it there.
Yeah, we're kind of splitting hairs, I guess.
We are. Since then, the market has come back some.
Yeah, well, we're up over 6%, almost 7% on the year, 6.7 I think it is.
Absolutely. What's interesting to me, though, is, if you watch these videos monthly, we always talk about technology being the top performer. For once, year to date, technology is not the top performing sector in the S&P 500.
Yeah, healthcare.
You have healthcare leading the way, 14.37%.
Yeah, by almost 1% better than.
Tech has still had a great year, up 13.77%.
Sure. One of the other things, we're in the middle of earnings season. Third quarter earnings season is about 90% of the way completed as we record this video. We got huge news in earnings, still up over 26% year on year.
Yeah, beat expectations by about 6.69%.
Right.
So a good earnings season, which is kind of what was expected.
Surprise
to the upside.
Almost 7%. And again, we have energy that really knocked the cover off the ball, 125% growth year over year. Not real surprising when you see the move that we've seen in crude oil. And also consumer discretionary is up huge. We've got an almost 15% earnings surprise in discretionary stocks.
Right. Latest election news?
Right.
Yeah.
Right.
Republicans gave up the House.
Yeah, and once again, the stock market, the S&P 500, down for the 6 months prior, usually indicates a change in power in Congress. So, the market told us once again. That's what's going to happen.
Makes you think that things like policy changes such as additional tax reform, you'd expect those types
off
of
the
things
table,
aren't going to happen now.
Yeah, there's a little bit of rumblings on infrastructure moving forward. I've seen Pelosi out saying maybe we can work together on that. But some of the other things that Trump would probably be trying to do had he won the House are off the table now. So now it's a little bit more coming together. And I feel like tying the two together, if you talk earnings and what we saw, 26.7% earnings growth. That's probably peak earnings growth. So we're at a point where peak earnings growth, there's concerns about tariffs and then there's concerns about rates. So one of the things with tax reform kind of off the table now, it's taking some of the upward pressure off rates off a little bit.
Yeah,
sure.
Right? Absolutely. Yep. So what we saw in October, actually value stocks outperformed growth. Growth being technology. I mean, we covered that a little bit. Jacob, you had a note.
Yeah, so if you look to October, we saw value actually outperform growth by 2.75%.
That's significant.
So sounds like a lot, but compared to how it looks on the year where value is trailing growth by almost 10%, 9.7%.
Yeah, wow. Yep.
So it's picking up a little bit off growth, given the environment, and value over time has outperformed growth. But it's been, past year and a half, it's been a growth story. So perhaps a little bit of a rotation there. We'll have to see moving forward, but we got our eyes out there.
Well, talking like economic fundamentals.
Absolutely. That's where
you look at the latest GDP number.
3.5%.
3.5%. Great number there. Great unemployment report for October.
Yeah.
250,000 jobs added. Unemployment remained at 3.7%.
Much better.
Wages picked up.
Yeah, wages picked up. We see wage growth at 3.14%, and that's well above CPI. So we got nice real wage growth there. Also, job openings are abundant. I mean, we're almost at 1.2 million job openings above the actual unemployed looking for work group. So,
sure.
Yeah.
One other thing.
Interest rates.
Yeah, interest rates, and I was going to tie that actually into housing. We've seen rates go up. Obviously, as a result, mortgage rates have gone up, and something we've seen deteriorating for several months now has been the housing. New home sales continuing to slump.
Yeah, down over 13% year over year. You're seeing kind of the high-end market, especially if you look at like Manhattan, start to roll over a little bit, and housing affordability is kind of coming off with the mortgage rates up. You see mortgage applications down. So that's kind of something to look at. It's kind of like a little bit of a bellwether for the overall economy and sentiment. You make your big purchases, those sorts of things. So.
Sure. Yeah, interest rates, I still believe, is the single biggest story in the market. We saw inflation tick down the last couple of months. It's down to 2.3 was our last indication, but we're looking at a number for October expected to be 2.4%, so a slight uptick there. The Fed's got a rate meeting coming up in December. 76% or thereabouts.
That's the options implied.
Probability.
If you look at kind of some of the research shops out there, I've seen a lot of people publishing in the 90s, 95% likelihood, and then kind of looking into 2019, still expecting one hike per quarter.
Yeah.
Yeah, and we got a meeting this week, and the market interpreted it as hawkish.
Yeah.
Because nothing really changes.
Nothing
it looks
at
like
all.
pedal to the metal. Let's keep going.
Yeah,
So,
the fear that we have is, maybe the next, or especially if we get two in the next 4 months, we could see an inversion of the yield curve.
Right.
We're down at 25 basis points differential between the 10-year Treasury and the 2-year Treasury. We had a bit of an increase up to 3.2% on the 10-year. They consider it a confirmation of growth, but that growth leads to inflation, and that's what the Fed is looking to keep kind of under wraps.
And it is right now. If you look at the PCE, the inflation measure the Fed uses, we're right at 2%.
Yeah, and that's their target.
to round that up, I feel like, if you look at the activity levels and you look at PMIs, that sort of stuff, it's excellent. But
Yeah.
we have a tightening of financial conditions, and the other kind of bogey that is kind of fallen out a little bit is tariffs. Right now, we got a 10% tariff on China, on about 60% of their exports.
Right.
That's set to move to 25% to start the year. And one of the things that's been helping them is their currency has weakened. On the year, their currency has weakened 10%, so
Yeah.
completely offset the tariff.
A lot of that's
right?
managed
And-
as well.
Right. If I'm Trump, I'm seeing the trade deficit continue to widen. That's one of my policies.
Yeah. Right.
So we might see him get more aggressive with this. So
Yeah.
that's definitely a concern moving forward.
Yeah, but the fact that he's lost the House of Representatives, it might temper
yeah.
him. So it's
Correct.
hard to say exactly what we have. I really believe we're probably looking at some stalemate in politics, domestic politics. Sure. I still believe the market's going to finish positive for the year, and we're still watching, trying to get an indication as to where we are in the business cycle. But it feels like things are doing really well. We just fear that it might slow down. Still saying, if you haven't rebalanced your portfolio, do it now. But at the same time, stay invested in equities. Make sure that you follow your long-term strategy. And equities are almost always a part of anyone's strategy, especially if you're trying to grow your wealth. This has been your market update for November 2018 from Henssler Financial. Thank you for watching.